What if I told you that most people who hit $300,000 in savings will never see 2 million? Not because the math is broken, not because the economy is rigged against them, but because at the exact moment their money was about to do the heavy lifting, they got in the way and stopped it. Right now, somewhere in the world, there is a person who has been saving faithfully for 15 years. They have done everything right. They cut their subscriptions and they packed their lunch and they said no to the vacation. They have $300,000 sitting in an account and they feel proud. They should feel proud. But here is what nobody told them. The first 300,000 was the hardest part of the journey. And the next 1.7 million requires almost nothing from them. Almost nothing except one thing that turns out to be incredibly hard for most human beings. In this video, we are going to follow Amara, a 31-year-old with $300,000 saved and a silent employee who is about to change her life forever. We are going to look at the brutal math behind the $2 million number. We are going to break down the 3 failure modes that derail most people right at the finish line. And we are going to show you exactly how to get out of the way and let the math do what it was designed to do. Stay with me because the next 30 minutes might be the most important financial conversation you have all year. Before we look at what Amara is sitting on, we need to understand something that school never taught us. Wealth is not built by one person, it is built by 2. The first person is you. You go to work every morning and you trade your hours for a paycheck. You are the one doing the visible labor. You are the engine that starts the machine. The second person is your accumulated capital. This is your second employee. In the early years, this employee is weak. If you save $10,000 and it earns 10%, you only made $1,000. $1,000 does not feel like wealth. It feels like a rounding error on your salary. This is the first trap because the second employee feels so small and useless in the beginning. Most people ignore him. Some people spend his paycheck on a holiday or a new phone. They do not realize that firing him in year 3 is the same as giving up $2 million in year 30. Here is the math that proves it. Amara has $300,000 today if she puts it in a broad market index fund and earns the historical average of 10% per year. And she never adds another dollar, not a single cent. That $300,000 becomes $1.96 million in 23 years. She barely has to do anything. The second employee does not take sick days. He does not ask for a raise and he does not need health insurance. He works 24 hours a day, 7 days a week, 52 weeks a year. And every year he gets a little bit stronger. This is the fundamental truth of compounding wealth. You are not trying to get rich by working harder. You are trying to stay out of the way long enough for your second employee to get rich for you. Now let us look at the actual numbers so you can see what Amara's money does decade by decade. In year 1, Amara's $300,000 earns 10%. That is $30,000 to most people. 30,000 sounds decent, but it also sounds like something she could have earned at her job. So the second employee still does not feel impressive. By year 10, her account has grown to $778,000. She added 0. The second employee generated $478,000 while she was living her life. Now she starts to notice him. By year 15, she crosses the $1 million mark. She is now a millionaire and she has not worked a single extra hour to get there. By year 23, she has $2 million. The original $300,000 has multiplied by 6.5 times. The second employee generated $1.7 million that Amara never had to earn with her own 2 hands. Here is the detail that most people miss. In the last 5 years of that journey, the second employee made more money than in the first 18 years combined. This is the snowball effect. In the beginning, the snowball is the size of a marble. It rolls and it rolls and it looks like nothing is happening. But in the final stretch, the marble becomes a boulder. The growth becomes visible. The math becomes undeniable. This is why patience is the only skill that actually matters, not stock picking, not market timing. Not reading financial news every morning. Patience. The willingness to let the snowball roll without kicking it. But here is the brutal reality. Most people kick the snowball. They kick it at year 5 when it still looks small. They kick it at year 10 when they get bored. They kick it at year 15 when the market scares them. And every time they kick it, they reset the clock and lose years they can never get back. Now we need to talk about the 3 specific failure modes that destroy the $2 million math. These are the 3 ways most people fire their second employee at exactly the wrong moment. The first failure mode is what I call the performance trap. Imagine it is year 7. Amara's account has grown beautifully. She is sitting on $580,000. Everything is working. But then her colleague at work tells her he has turned $20,000 into $80,000 in 8 months by trading a specific coin or a specific hot stock. Amara hears this and her 10% return suddenly feels embarrassing. This is the performance trap. It is the moment when boring becomes unbearable. She takes her money out of the index fund and puts it into something exciting and fast-moving. She has just fired the second employee who was on track to make her $2 million and replaced him with a gambler. The research on this is devastating. A study of millions of retail investment accounts found that the average investor underperforms the market by about 1.5% per year simply because they keep switching strategies. Over 30 years, that gap is not 1.5%. That gap is the difference between $2 million and $1 million. The colleague who made $80,000 in 8 months almost always gives it back. The person who holds the boring index fund for 30 years almost always wins. The performance trap kills more wealth than any market crash in history. The second failure mode is the panic sale. The stock market has a very specific personality. It goes up over long periods of time, but it is designed to terrify you in the short term. Every few years, without fail, the news will tell you the world is ending. Headlines will scream that the economy is collapsing. Your account balance will drop 20 or 30% in a matter of weeks. This is the ultimate test of the second employee relationship. Because when your account drops from $500,000 to $350,000 in a single quarter, your brain does not feel the long-term math. Your brain feels fear, and fear tells you to sell. Here is what Amara must understand: a drop on paper is not a loss. It is only a loss if she sells. If she holds and does nothing, the market has recovered from every single crash in the last 100 years, every single one. The people who sold during the crash of 2008 locked in their losses. The people who held or who bought more came out the other side richer than before. When you sell during a crash, you turn a temporary paper loss into a permanent real one. You are telling the second employee to stop working at exactly the moment he needs to push through and recover. The panic sale is one of the most expensive decisions a person can make in their financial life. The third failure mode is the fee leak. This one is quiet. It does not announce itself with headlines. It does not feel dramatic. But over 30 years, it can steal more from you than the other 2 failure modes combined. Here is how it works. Amara decides to hire a financial advisor who charges 1% per year to manage her money. 1% sounds like almost nothing. It sounds responsible. It sounds professional. But watch what 1% does over time. On $300,000, 1% is $3,000 in year 1. But as her account grows, the fee grows with it. By year 15, when she has $1 million, the advisor is taking $10,000 a year. By year 23, when she should have $2 million, the advisor has taken $500,000 of her wealth in fees. She does not have $2 million. She has $1.5 million. The advisor took a quarter of her wealth, and the research consistently shows that most advisors underperform a simple index fund anyway. The fee leak is quiet and it is lethal. The solution is simple. Use a low-cost index fund with an expense ratio of less than 0.1%. This is the single most impactful investment decision most people will ever make. Not which stock to buy, not when to enter the market. Just use a cheap fund and leave it alone. Now let us talk about how to actually protect the $2 million math. Because knowing the failure modes is not enough. You have to build a system that makes it hard to fail even when your emotions are screaming at you. The first protection is automation. Amara sets up her investment contributions to happen automatically on payday. The money goes from her salary directly into her index fund before she ever sees it in her bank account. She does not have to make a decision every month. The decision was made once and the system runs itself. Automation removes the single biggest variable in long-term investing. When you have to manually move money every month, you introduce 12 opportunities per year to change your mind. One bad news cycle and you hesitate. One big expense and you skip a month. Automation eliminates that friction entirely. The second protection is deliberate ignorance. The most successful long-term investors in history are often described the same way. They set up their portfolios and then they mostly ignore them. They do not check their balances every day. They do not read financial predictions. They do not react to market news. This sounds irresponsible. It is actually the most responsible thing you can do. The research on investor behavior shows clearly that the more frequently people check their investment accounts, the more likely they are to make poor decisions. Checking once a quarter is enough. Checking once a year is even better. The second employee does not need supervision, he needs time. The third protection is what I call the identity shift. Amara stops thinking of herself as someone who is saving money. She starts thinking of herself as someone who owns a business. And the business is her investment portfolio. She is the founder. The second employee is her best hire. And good founders do not fire their best employee every time the market gets rough. This identity shift changes how she responds to market crashes. When her account drops 20%, she does not feel like she is losing money. She feels like her business is having a difficult quarter, which happens to every business. And she knows that difficult quarters do not define the long-term health of a great business. The fourth protection is the cash buffer. Before any of this works, Amara needs to make sure she has 3 to 6 months of living expenses in a separate high-yield savings account. Not invested, just sitting there liquid and accessible. This cash buffer is the reason she does not have to sell during a crisis. If she loses her job during a market crash, she has 6 months of expenses available without touching a single share. The buffer is not just financial protection. It is emotional protection. It gives her the security to hold through difficult periods without being forced to sell at the worst possible time. Now let us talk about what happens when Amara gets close to the finish line. Because getting to 2 million is only half the story. What you do with 2 million matters just as much. Most people who reach their number have been so focused on building it that they never thought carefully about how to use it. They hit 2 million and they feel the pull to stop working immediately. And then they immediately face a risk that almost nobody told them about. It is called sequence of returns risk, and it can destroy a $2 million plan in the first 3 years of retirement if Amara is not careful. Here is how it works. Amara reaches 2 million and retires. She plans to withdraw 4% per year, $80,000 to live on. This is called the 4% rule, and it is based on decades of research showing that a portfolio can sustain a 4% withdrawal rate indefinitely if markets perform at historical averages. But what if the market drops 30% in year 1 of her retirement? Suddenly her 2 million is 1.4 million and she still needs $80,000 to live on, so she is now withdrawing $80,000 from a portfolio of 1.4 million. That is not 4% anymore, that is 5.7%. And if markets drop again in year 2, the math starts to collapse. This is why the smartest people on the path to financial freedom build what I call a retirement runway before they walk away. A retirement runway is 12 to 24 months of living expenses sitting in cash or short-term bonds outside of the main portfolio. When markets are good, Amara takes her withdrawals from the portfolio as planned. When markets are bad, she lives off the runway and leaves the portfolio completely alone. She gives the second employee time to recover without forcing him to sell shares at a loss to fund her groceries. The retirement runway turns sequence of returns risk from a portfolio killer into a minor inconvenience. It is one of the most important strategies in personal finance and one of the least talked about. Beyond the runway, Amara also needs to think about where her money is located. Not just how much she has. $1 in a tax-advantaged retirement account is not the same as $1 in a regular brokerage account. Different accounts have different tax treatment in retirement, and getting the withdrawal order wrong can cost her hundreds of thousands of dollars over a 30-year retirement. The general principle is this. In retirement, you want to pull from taxable accounts first and let tax-advantaged accounts keep compounding as long as possible. The exact strategy depends on your specific situation and your country's tax laws, but the core idea is always the same. Be as tax efficient as possible so the second employee keeps as much of his paycheck as possible. Now, I want to step back from the numbers for a moment and talk about the thing that actually determines whether any of this works. It is not the market, and it is not the fund, and it is not the tax strategy. It is temperament. Warren Buffett, who is arguably the most successful investor in human history, was once asked what his secret was. He did not mention stocks, he did not mention spreadsheets. He said the most important quality for an investor is temperament, not intellect. The ability to sit quietly and do nothing when everything around you is pushing you to act. This is a skill that runs completely against human nature. We are wired for action. We are wired to respond to threats. When the market drops, our threat response activates, and it tells us to do something. Selling feels like doing something, holding feels like doing nothing. But in investing, doing nothing is often the highest value action available. Amara has to train herself to feel comfortable doing nothing. She has to develop a relationship with boredom. She has to reach a point where a 30% market drop feels less like a catastrophe and more like a sale on future wealth. Because that is exactly what it is. The people who win this game are not the smartest people in the room. They are the calmest people in the room. They are the ones who built a system they trust and then trusted it to run while they went back to living their lives. If you can master temperament, the math will do everything else. If you cannot master temperament, no amount of financial knowledge will save you. This is the most honest thing I can tell you about building wealth. Let us bring everything together and put it into a framework Amara can actually use starting today. Step 1 is to know your freedom number. Amara calculated 2 million because her lifestyle costs $80,000 a year, and 80,000 multiplied by 25 equals 2 million. Find your number. Put it somewhere you will see it every day. It is not a dream, it is a target. Targets are buildable. Step 2 is to automate the contribution. Set up an automatic transfer that happens on payday. Remove the decision from your monthly life. The second employee does not need your permission every month. He needs your trust and your consistency. Step 3 is to choose a low-cost index fund. The S&P 500 or a total market fund with an expense ratio below 0.1%. This single decision can add $500,000 to your final number over 30 years compared to a high-fee alternative. Step 4 is to build your cash buffer. 3 to 6 months of expenses in a separate account. This is not an investment, this is armor. It protects your portfolio during the bad years by giving you somewhere else to stand. Step 5 is to set your review schedule once per quarter or once per year. Look at your portfolio not every day, not every week. Once per quarter or once per year. Rebalance if needed, and then close the app and go back to your life. Step 6 is to protect the plan from yourself. Tell someone you trust about your plan. Write down your strategy and what you will do during a market crash, before the crash happens. This is called an investment policy statement, and research shows that people who write down their plan in advance are far less likely to make panic decisions when emotions run high. And step 7 is to keep going, not until it feels good. Not until the market cooperates, not until the news gets better, just keep going. The math does not care about your feelings or the headlines, it only cares about time. Give it time. The difference between $300,000 and $2 million is not talent, and it is not luck, and it is not connections. It is the ability to hire a second employee and then leave him alone long enough to do his job. Most people cannot do that. They get scared, or they get bored, or they get greedy. They fire the second employee at year 7 or year 12 or year 18, and they spend the rest of their working life wondering why their account never grew the way they hoped. Amara does not have to be most people, and neither do you. The math has worked for 100 years. It does not require a high salary or a finance degree or a lucky break. It only requires one thing: staying out of the way. Before you open another tab today, I want you to do one thing. Calculate your freedom number. Take what you need to live each year and multiply it by 25. Write that number down. That is your target. That is what your second employee is working toward every single day. And then ask yourself honestly, are you helping him or are you in his way? The clock has already started. The math is already running. The only question is whether you will let it finish. Share this video with someone who has been saving hard but has not yet understood what their money can do for them while they sleep. Because the sooner they meet their second employee, the sooner the math starts working in their favor. I will see you in the next one.